Time for hot picks in gaming and gambling. Our guest has DraftKings as his top pick, and he says the company's expansion into predictions has created some uncertainty for near-term profit, but investors are willing to hold the stock for more than a few months, could be in for a good opportunity. We're joined by Jason Tilchen, Senior Research Analyst in Digital Gaming and Entertainment at Canaccord Genuity. Thanks very much indeed for joining us. Just remind us now, DraftKings, we know, is a dominant player in sport betting. So they're getting into this predictions industry. Can you remind us what that will involve, please?
Yeah, absolutely. Thanks for having me on. DraftKings is really a pure play North American digital gaming operator, and growth over the past few years has been driven by an increasing percentage of the U.S. population with access to online gambling through state-by-state legalization, and increasing monetization of those users through product innovation. The key debate at the moment, as you mentioned, surrounding this stock is the impact that prediction markets are having on the regulated sports betting industry. The short version is that prediction markets, which initially gained popularity during the 2024 presidential election, really started to take off last year when they started to introduce sports contracts. And they really saw a spike of trading activity on these platforms during this past football season, particularly in states where sports betting is not yet legal. They're really able to do this by claiming these contracts are federally regulated swaps exempt from state gambling laws. And the reality is the matter is likely not going to be settled from a legal perspective for years, could end up going all the way to Supreme Court. So as it relates to DraftKings, there's two issues for the stock today. First is the level of investment they're making in their own prediction app, which they launched at the end of last year, and the impact that's going to have on 2026 margins. And then the second is based on the latest state data. There's been a bit of a slowdown in engagement across the industry. There could be a variety of factors that play into that, particularly over a short period of time. But there's a concern from some investors that these prediction markets may be starting to have a little bit of a cannibalization impact on regulated platforms. So the combination of those two things has really pressured sentiment around this stock. And while we do expect shares to remain volatile until the company provides 2026 guidance in a few weeks, I think the sell-off ultimately has created a very attractive valuation for a business we forecast is still going to roughly double its EBITDA to around $1 billion this year, even after those prediction-related investments, with additional top-line growth and margin expansion going forward.
And sorry, we're really tight for time, but will this move into prediction markets alienate sports partners, the sports leagues, if DraftKings does that?
So I don't think it's necessarily going to alienate them. They've definitely taken a cautious approach. Each league has taken a different approach to this as well. The NHL and MLS are two leagues that have actually partnered with prediction markets. Others, like the NFL, are taking a little bit more of an arm's length approach for now as this emerging industry develops. But definitely they take all stakeholders and put them in mind when they're making these decisions around product innovation.
It really is amazing, the boom in gambling around the world. Flutter Entertainment, FLUT in New York, what do they do?
Yeah, it's actually a pretty similar business to DraftKings, but in addition to having one of those leading platforms in North America by market share, which is FanDuel, they also have a portfolio of online and omni-channel gaming brands around the world. So a little over 40% of their total revenue today comes from North America, the balance from international markets. But their strategy has really been to acquire a local brand that has a podium or near podium position in attractive growth markets, and then to sort of pour gasoline on those businesses by taking best practices developed over the past 2 decades around the world and applying those to drive share gains and operating efficiencies. Same game parlays is a very, very good example of this. That was initially developed by Flutter in Australia back in 2016, and they've brought that to the U.S. and other markets, and allows them to really generate more revenue per dollar wagered relative to other companies. They can reinvest that back in promotions and product development, and sort of it's a pretty virtuous flywheel that's been driving really strong retention and engagement for them over their entire global operating footprint. But in addition to those prediction market dynamics that we just mentioned in the U.S. market related to DraftKings, they've also been facing some tax increases in other markets like the U.K. But the good news is that we think all of this has sort of been more than priced in at this point, with the stock down over 20% so far this year, nearly 50% off highs from last summer. This is a really quality, diverse business with great management team. And for investors, as you mentioned, with a longer time horizon, I think this is definitely a very attractive entry point, trading at less than 12 times consensus 2026 EBITDA.
And finally, Sport Radar, SRAD. Why do you think this one offers promise?
Yeah, this is a pretty unique business. It's more of a picks and shovels play on the global online sports betting market. So they're one of the leading data providers to sports betting and media companies. They sit really between the leagues, who they pay for the exclusive right to collect and distribute their official data, and the sports books and media companies who use this data. And it's really, especially for the sports books, a mission critical product. The larger books like DraftKings and FanDuel, they need this low latency data feed that Sportradar provides for their in-house pricing teams. And then there's a variety of hundreds and hundreds of mid-sized and smaller sportsbook operators around the world, and they offer a variety of additional services and managed trading services and odds feeds to those companies as well. And in addition to sort of the organic growth that they continue to experience due to the global market expanding, margins should continue to increase roughly 1 to 3 percentage points annually. That's because they've just completed sort of the latest renewal cycle for most of their key sports properties, so there should be limited growth in what is their largest expense, and then allow them to sort of develop new products to enhance monetization of those rights and drive operating leverage over the next few years. So the stocks really had a sharp sell-off due to the sentiment across the sector, but they're mostly unaffected by these issues that have been challenging the B2C operators, and we think unfairly punished as a result, which again only creates a pretty attractive opportunity for investors.
Jason, thanks very much indeed. You covered a lot of ground there. Thanks on this industry that's just exploding. Really appreciate it. Jason Tilchen, Senior Research Analyst in Digital Gaming and Entertainment at Canaccord.